Good morning, ladies and gentlemen. Well, after the figures that we had for CPI and PPI, the market is now stuck between the dot plots between one hike and two hikes and discounting the eventual terminal rate. It'll be a while before that argument is resolved. I still think that two is more likely than one, but I think in the next couple of weeks, the market is actually going to coil, and let's have a look at what the implications of that are. Quite rightly, the very short end, 1 month, 3 months, 1 year, did absolutely nothing last week, just a few basis points differential. Why? Because we had already discounted, or very close to discounting, the possibility of two hikes going into this Fed meeting. The CPI and PPI gave some doubt as to that narrative, and we went back down a little bit, so we are basically at one. If we look at the twos, overreacted back up. If we look at to the fives, overreacted back up. I think that we are now likely to trade in this range in the fives between 392 and let's call it 419 for a considerable period of time, certainly till the Fed comes along and gives us something more to trade on. I certainly think that fives, tens and 30s are going to be in a very narrowing range simply because we don't have enough data. And that is making the MOVE index come down. You can see how much it came down last week, basically back to the lows, and how little it's gone up on Friday, even though the market gave up quite a bit of ground, especially at the short end, and will continue to do that. Because I just don't see that the market is going to price out even a few basis points of probability that the Fed hikes in 2 weeks' time or 10 days or whatever it is. The Fed will hike. It's what happens after that that we are arguing about. I think MOVE will continue to come down and will probably test the lows around the 97 level. And I think that selling calls and selling puts out the money continues to be a favored trade. If we look, at the 30s, look how tight this range is. I think the odds of us going beyond 405 are almost zero, and the odds of us coming down below 380 are also very, very low. So that is the narrative that you have for the next week. We trade in a range of not too much higher than we saw on Friday in the 30s to not much lower than we saw on Fridays. The fives, I think that they've got more chance to give up. And that means that the yield curve will flatten again. So if we look at 5s, 30s, we are looking for a top around here, 19, something like that, another 8 basis points. And the low is not going to be anywhere, nowhere near more than we already saw. And the 10s, 30s, we might get back up to -6, that kind of thing, but no way do we go negative again. Unfortunately, this is about as high as it goes, the -6, and then we see again. Or maybe we could get to -3. But from now on, I don't think the likelihood of 10s, 30s going negative is very high at all. And the likelihood of seeing the levels that we saw, at 449 in fives, almost zero. I would have thought that selling any puts on prices around this area is excellent, and selling any calls around here is excellent as well. I think that we will just meander between 420 and 4 for quite some time in the fives. As the future path of inflation as the probabilities of the future path of inflation narrow in the US, they're also narrowing in Europe. What I'm trying to say is that if the unknown volatility of future inflation is perceived to be going down as a result of the CPI and PPI numbers we saw, at least in the very short term, that probability gets mirrored in the European rates. So you can see how little Schatz moved, and you can see how little Bobl moved, and you can see how little the Bunds moved. And I think that that is precisely what is going to be mirrored in the next few days. I think it's unlikely that the Bund go above 258 for the time being. How low? I don't think it's going to go much lower than these levels. And that gives us actually a cross between the 10s and the 10s, which is stable. I would argue that one of the reasons why we had such a violent move in the US was also because we were at an extreme in price in the crosses, and therefore people had to liquidate their excess shorts in the US and transfer it into the Bunds. But now I think that this remains stable between this kind of level, 128 and 140, certainly for the next few days. And after all, this video is only about what is likely to happen next week. So I think that it's likely to remain, whether we look at 5s or 10s, it's likely to remain in this range. And we are likely to see more weakness in the US as that move gets basically not taken out, but gets somehow reduced, and we trade around the 147 level. So I don't think that next week we're going to see more pressure on the European rates than we see on US rates. Quite the opposite. I think we will see more pressure in the 3s, 5s area in the US than we will in Germany. But it's all going to be very, very marginal. So I foresee a week of very narrow ranges, and certainly narrow relative to each other, in Germany and in the US. And I think move comes down, and I think you sell all the extremes in volatility in the options at higher strikes and lower strikes, and basically look for a market which only goes sideways, pricing itself into the Fed just over one hike away. Because I think what the Fed is going to say again after they've hiked is that they are completely and totally data dependent, and they'll be looking more and more at unemployment, which doesn't allow them to take the foot off the brake, because the unemployment numbers in the US are getting if not more extreme, they're certainly keeping the extremes that we have seen. And therefore, I think it's very unlikely that the market can start pricing in, or keeps pricing in, more than the cuts that we are seeing priced in at the moment. In fact, if anything, they should lessen that, and the US should slowly drift higher in yields, while the yield curve basically flattens. I certainly don't think that the extreme steepening that we saw last week, and that we were able to take slightly advantage of, is going to be maintained for any length of time. I want to be sure that I am absolutely clear about what I think is happening. If you have a look at this five-year forward inflation expectation rate, it's not coming down, is it? It's 233. It's very much gone up in the past week by, 1 or 2 basis points. But what I think is happening is that the volatility of these expectations is narrowing. The CPI's path is down. The only question is how far core comes down, and the data that we've had basically suggests that the core is sticky but coming down. And that narrows the volatility of the expectations of where we will be in a certain period of time, whether we are higher or lower. It's narrowing those probabilities of volatility. It's not narrowing what the expectation itself is. The expectation is still way above the Fed's target. And therefore, I think that 1 hike is definitely done. 2 is probable, but more than 2 is becoming unlikely. And therefore, I think that this will remain in a tight range, much tighter than we have seen since in this data. I would not be surprised at all if we just meander sideways and remained here around 2.3 for a prolonged period of time, certainly a week. And if that happens, then the likelihood of less volatility in the yield of, say, 2s, 5s, 10s, and 30s is higher. But, and this is a crucial point, as that volatility goes out, then the cuts that are priced in going out in 2024 and 2025 also should be priced out a little bit at the time, i.e. the Fed will start cutting later and later, and therefore the probabilities that, say, 2s or 5s go down in yield from the levels that we saw on Thursday also recede. What we basically saw on last week was a yield curve which had achieved all its targets, minus 42 in 5s 30s, minus 6.5 in 10s 30s, and had basically flattened huge, and also was at an extreme against Germany. And therefore, when it came time to unwind those extremes, the move was very extreme in the outrights in the US. But this does not say that we need to move down in yield. This says we need to lower the volatility band of the probability of where inflation is going to be, and therefore lower the probability band of us going outside what we have seen as a range in 2s, 5s, 10s, and 30s. Last week, the dollar got hit hard as those interest rate differentials came in. I don't think it goes much further. In fact, I would bet that it goes back to this kind of level, 101.65, something like that. As I said, I don't see those differentials coming in any further. And what does that mean for Euro USD? Probably something like 111 would be my favored back, or maybe even 110.64. I don't think next week is going to be a week in which the dollar takes it in the neck, because I just don't see any reason for it. The interest rate differentials, as I showed you, are more likely to go up than come down, and therefore I'm neutral on the dollar to slightly bearish. I just don't think that we are going to get an extreme follow through, and I see no reason for it. The only thing that I can say about gold is that it should have gone up more. And that is that it underperformed the amount of by which DXY went down and the amount by which bonds rallied in price. That tells me that people aren't really playing gold, and it will remain in a range. Now, what that range is, I don't know, because it did close above 1959, and therefore we have, a reasonable likelihood of trading 1975 here at the top of the Bollinger Bands. But it should remain in this kind of a range, basically not giving any further hint. I'm not going to buy a laggard. Gold is a laggard here, and I see no reason to buy it at these levels. I don't see much of a reason to sell it because, let's face it, it's very much supported by the 200-day moving average. So dips are probably buys, dips towards this 1925 level. It never got to 1881, and I don't see any reason why it should, because the bonds, let's face it, are not going to go to those extremes again, if I'm correct. And if that is the case, I would have thought something like 1940 is going to be as low as it gets next week before trying some more upside. As far as oil is concerned, it keeps on failing at the 200-day moving average. And therefore I just can't get outright bullish in oil, and therefore I can't even get outright bullish in DBC. I think this 24.39 level is going to hold it, and it's going to remain in this pattern in which it's been several weeks. This is, like 3 months. What it's showing me, and especially in gold against DBC, I expected this move down, but now it's running out of time, and basically very soon, say 2-3 weeks time, it'll be time to start buying gold again against DBC. So nothing for now, but I'm keeping a very good eye on this. And I would have thought that if we see this dip down towards 736 in the ratio gold DBC, it'll be time to switch. Copper is not giving me many clues, but it's basically telling me that we might have seen the lows, and the 200 moving average on the dailies is turning up. So I'm a buyer of the dips in copper, and copper gold is not really telling me anything. It's just fuffing around. So, again, another reason not to sell gold, but not a huge reason to buy it either. And really, I would prefer to buy copper here than to buy gold. But I am very undecided, and these are all marginal trades. The risk-reward probabilities are not high, and you know me, I only go for really decent risk-reward probabilities. I would leave this stuff alone for the time being still. The market made another lunge towards the times 20. We had the JPM earnings, those were good. Other banks, it's not surprising, but you saw the JPM price action. I mean, I sold quite a bit of JPM on the results, and the market basically closed up 0.5%. So I think that a lot of this stuff is in the market now. The fact that the volatility of bond returns is going to be lower tends to give me confidence that the VIX will remain lower for next week, or that we won't have a spike in the VIX, and therefore that the volatility in the S&Ps will not be that great. I think we have discounted the kitchen sink in terms of earnings, so this is unlikely to start moving up. And at this level of multiple, it's unlikely that we can go much higher. Therefore, I think that a period of sideways next week is far more likely than not. So what would be good technical levels to get some put spreads on board if I don't think that the market can go all that much higher? Basically anywhere between 45.42 and 45.89 in the SPX. That seems to be technically a very good level to short, and I certainly don't think that we'll be awaiting the Fed there for, some good reasons. And one of the main reasons is this. Look how far we are above the Bollinger Bands on the dailies, and I would expect us to be somewhere close to a moving average before the Fed. I mean, unless the market doesn't fear the Fed at all. So I would expect next week to be between, say, this level, 44.55, and this level, 45.50 in terms of SPX. If we get to this level, the 45.80s, I think the odds really do favor a put spread at that level. Now that is all short term. Longer term, this is what I'm looking at to give me a signal, because my reasoning goes as follows. The SPX has been dragged up by the NDX components within it, and really the market of the Dow has gone sideways for 9 months. It's gone nowhere. Okay, so for 9 months here we've had zero return. Either the Dow starts catching up, in which case then the SPX can go up even without the NDX. So it really doesn't make that much difference what the NDX components do. Well, it does, because there's Apple in here, but you understand what I'm saying. If the other components, like that the Dow is heavy, like XLF, XLI, start performing, then yes, then I can remain bullish or not hedge my SPX positions. But to me, the likelihood that we just, stay here is very low. Either we will have a close above this 34,590 level in DJI, in which case we can definitely get towards this, 36,500 area, or we fail completely, in which case we probably go back down to 32,600. I have no idea which one of these two will happen. I would have thought in a period of stability of bond prices, the likelihood slightly shifts to the upside than to the downside. But, I would not like at the moment to put too much money on it. And you can see how many times this range has been traded, or at least this range, down to 33,200. And therefore, I definitely would not like to get long here until I get a close, certainly at least a weekly close, preferably a monthly close, and we're only 2 weeks away from that, above here to look for this kind of level. That is just about all I can tell you longer term. Shorter term, I don't think it breaks. Another reason for stability next week is the Nikkei. It's corrective. I doubt very much that we see it below this 31,600 level. I think that is a decent risk-reward buy. Certainly, cool spreads, but unfortunately, the stop would have to be below 30,800. I don't think that is likely to happen, and I will be a small buyer, I think, at those levels. That's all I can say. It remains corrective, and to me, the target is still 3,600. What I would like to see is this slightly correct more, stop people out, stop the Dow from breaking higher, and then both the Dow and the Nikkei doing a spurt later on. I think that that would be what I would like to see, but you never get everything in life. So I would definitely buy the the Nikkei, because I think the risk reward is good if it goes down to 31,600 next week with an 800 point stop. The stocks basically reversed all the bearishness of the previous week, but it really isn't leading, is it? So the ratio is nowhere near what it was before in terms of Europe leading the US and the US lagging. So at the moment, I just don't see any signals coming from this market. The only signals I think that will be important will be signals on the downside, when it starts really leading to the downside. And really, it's not happening at the moment. It's in a range, it's a very wide range between 42.26 and probably the top of the Bollinger Bands. We'll see next week if it breaks higher. And if it can't maintain and comes back down towards 43.66, that will tell me that all markets are tired and they're still not going to break out. One final idea is, we'll come up to it, but this is TLT over VWOB. They're very comparable in terms of duration, but not in terms of credit, because VWOB is dollar-denominated debt issued by much lower credit sovereigns than TLT, which is a UST. Now, this trend to me will continue, because if I'm right with the argument that I made earlier, that the volatility of the path of inflation diminishes, and therefore the volatility of the bond market is going to diminish, then credit is going to get bought, and those differentials are going to come in, i.e. VWOB will continue to outperform TLT, especially because TLT is yielding whatever it's yielding, let's call it under 4%, a tad, and VWOB is yielding over 7% with a 5% monthly coupon. Now, that is very attractive if I'm correct in my reading of bonds, but that leads you to the belief or to the idea that emerging markets could actually outperform now the US market. And these are the spreads. This one is against the SPY, EEM over SPY. You can see how low we are, and we've turned slightly. This one's against Japan, against Germany, and against Europe in general. You can see that emerging markets this year have not done very well. And if we go and have a look at EEM itself, you can see that finally it's beginning to break out. Last week was a very good week for EEM, and I think that that likelihood is likely to continue. I just don't see why we wouldn't break higher and reach at least 42.25 over the course of the next couple of weeks. So I'm looking for dips to buy in EEM, certainly 39.93. But anything that we get below this weekly Bollinger Band, I think is going to be a good week, a good opportunity rather, to buy it for at least 42.25. I certainly think that there is room in emerging markets to break higher against the US market, simply because I think those bond yield differentials will come in. And with that, onto the bias and level sheet. I think, as I said, it's going to be a quiet week. Bonds, I'm looking to short rallies and buy dips. I think that that is as simple as that. I want to trade the range, and I'm quite good at that, and I quite like doing that. So that's all I'm looking at, both in the US and in Germany. I think the spread slightly goes out, and therefore DXY is going to remain stable. I certainly don't see it below 99 or staying below 99. I think it's more likely to go back up above par than not, or certainly even 101. As far as everything else is concerned, I think it's the summer doldrums and it's going to remain like that. The market is just going to trade technically and go into the Fed at a technical level. The only thing I really like the idea of is buying EEM on dips and taking advantage of that rather than the SPX. Thank you very much indeed, and tweet you on Monday.